name is Melanie Shabangu. I am the Tax Director Partner at AVASK Accounting. As you guys already know, we're going to be back again next week on something different. We're going to be back on global expansion or the Expander series. But today, Martin, can you just briefly introduce yourself and your company, and also Stephen afterwards? We've got literally 60 minutes today. At the end of this presentation, please make sure that you start putting through your questions. But even if you feel like you've got a burning question that you're going to be missing at the end, or you're going to be forgetting it, just continue posting it on the Q&A. We've got somebody behind us, got Alex Redman, who is going to be answering all your questions that you may be having this morning. And also, if there's any questions that we've missed by any chance, then we're going to have Martin and Stephen answering those questions. Thank you again. Over to you, Martin. Please do an introduction of yourself.
Thank you, Melanie, and for that warm introduction, and good morning to everybody, and hopefully you're looking forward to the weekend ahead. My name is Martin Brunt. I'm co-founder of Lester Brunt with my business partner, Mike Lester. We're based in Dorset, although we have offices in Alton. We're one of the senior partner practices within St James's Place. We're one of the top 10 practices within St James's Place. So hopefully you'll feel comforted by the fact that we've been established for a long time and that we know what we're talking about. So hopefully you'll follow me through the slides and Stephen Birrell and ask any questions as you have at the end. So Stephen Birrell has been with us for about 5 years. He's a pension specialist himself. He's going to be taking through the slides with you. But a little bit of background, first on St James's Place. They're founded in 1991. They're one of the largest financial services companies in the UK. Very successful organisation, fantastic growth over a number of years. There's about £117 billion worth of client money under management. And to be a partner at St James's Place, you've got to be highly experienced. Particularly in this marketplace, it's important to stay close to clients and provide them with a service that they need. Lester Brunt itself, as I said, founded by myself and Mike Lester. We have around about £500 million worth of clients' money. So nowhere near as big as 117 billion, but still a substantial amount of money. Plenty of experience in our practice. Very proud of the people that work with us. We've got about 50 staff offering advice and support to our clients, largely up and down the M3 and the M4 corridor. But there's plenty of opportunities for us to be speaking to clients in some key areas, be that pensions, investments, or inheritance tax, as just to give you some examples. So we're very holistic in our approach. So just about to hand over to Steve. Steve started with us about 5 years ago, has done extremely well within our practice. He represents the future of our business, a young professional person. He's qualified in DB schemes, specifically for pensions. Is a senior advisor within our practice, and he tells me he's a keen golfer and cyclist. But more of that perhaps another time. So Steve, over to you.
Thank you, Martin. Good morning, everyone. So what are we going to be talking about today? I guess is on the tip of your tongue. So we've alluded to the fact that planning for entrepreneurs and business owners is incredibly important, but I'm going to focus specifically on why pensions should be part and parcel of those plans. Now, the question you see on the top of your screen is, why should I invest into a pension? But I'd like to ask the question, why should I invest into a pension as a director or business owner? Now, what I see and what Martin and I tend to see quite often is that business owners are focused on driving the business forward, which is absolutely understandable. But what we tend to see then is that you retain profits within the company and miss valuable tax saving opportunities along the way. And therefore, you are neglecting valuable profit extraction opportunities that can create long-term wealth for your families. And this is where pensions come in. Now, as you can see, there are a number of invaluable benefits and reasons why you should invest into a pension, but today's presentation is mainly going to focus on the tax element. So when we look at savings into pensions, we get tax relief, be it personally or as a company. You get tax efficient investment growth. There are a number of different ways that you can enjoy your pension income when it comes to retirement. Let's not forget, pensions are also inheritance tax free. So whatever pension you can't manage to spend into retirement can go to your family, can go to your children and your children's children. So we're seeing a means of which we can create family wealth that can go down the generations. And let's not forget, there are tax efficient ways that your beneficiaries can access those funds as well. So let's look at how tax relief works. So in this example, we've got a £100 contribution to a pension scheme, and this is by a private individual. Now, what you can see is when you pay into your pension, the government pay in too. So that's the government helping you save for your retirement. Why wouldn't you look at that as a means of saving for the future? So working from left to right, you can see that as a basic rate taxpayer, for every £100 paid into a pension, you only have to pay 80. So that's £20 in tax relief from the government for every contribution that you make. A higher rate taxpayer, you only have to pay 60. That's £40 from the government. And for the unlucky or lucky few additional rate taxpayers, you pay in 55 and the tax relief is £45. So that's how it works for a private individual. Now you're probably asking, well, how does that work if I make the contribution from my company? So yes, that is possible. You can make payments as a business owner or director into your own pension fund, and the company gets the tax relief. So that means every payment that you make into your own pension scheme is an allowable business expense. It's reducing the corporation tax bill that you might otherwise see when retaining profits. So let's look at a quick example as to how that might work. So this applies to everyone sat in that run their own company. You as a director could pay in £40,000 in any one tax year. Now, you could also use carry forward to pay in a further £120,000, meaning there's £160,000 placed into your pension fund, reducing your profit, and a fantastic corporation tax saving of £30,400. Now, making that payment has not incurred any tax liability to you or to the business. Isn't that a fantastic way that we can save into our pensions by just taking advantage of the rules as they stand today? Now, pensions tend to be fraught with rules, and that tends to be a huge reason why majority of clients I see tend to steer clear of pensions, because you get well, they're very complicated. Now, what you can see on the screen is a overarching summary of the pension rules. Now, I don't see those as reasons to not save into pensions. I see them as unused opportunities. So you can pay in as a private individual £40,000 a year or 100% of your earnings and get tax relief. Now, let's not forget, you're getting tax relief on the money going in, but the government is also allowing you to take 25% of your fund tax-free. So just as an example, £100,000 that comes out of your pension fund, you can get £25,000 tax-free. Let's not forget, non-taxpayers can benefit too. So if you have children or partners who aren't working, you can still make valuable pension savings for them. Briefly taking a step aside in looking at the opportunities that are available to you as business owners, let's not forget, if you have employees, so that is an employee that's not a director, you have a responsibility to pay into a pension scheme for your staff. Now, what might that look like? the government has set out rules around minimum contributions. And you can see that, assuming you are an employer, you need to set up a qualifying scheme that looks like something on the screen in front of you. The question I would ask is, do you have employees? And if the answer is yes, have you got a qualifying scheme in place? And if the answer is no, you need to look at that sooner rather than later. Next slide. As an employer, then, you will have to assess your employees, and they fall under two broad categories: eligible job holders and non-eligible job holders. What you're going to be looking at is, based on age and earnings, you either need to enrol those members of staff into your pension scheme or give them the option. So really, really crucial, because the pensions regulator is hot on fining non-compliant businesses. So what we don't want to do is to get too focused in on what can I do as a business owner and forget that you have a responsibility to your employees. So coming back to profit extraction. So what can I do if I have some pre-tax profit to spend? That's a very good question. Now, in this example, we look at £20,000 of money sat within your business that you might be looking at taking out. So you've got, in my mind, three broad options. You can pay that to yourself as salary. Now, in that example, you can see the benefit to the individual of a £20,000 salary payment is £10,193. You may be inclined to actually pay that as a dividend. So that's the most common way that I see business owners extracting profits is through additional dividend payments. You can see that a £20,000 dividend payment gives you £10,935. So that's the benefit to you as an individual. But what about a pension contribution? A £20,000 pension contribution, assuming that is made and taken out by a higher rate taxpayer, gives you £14,000 of benefit. So that's £3,000 higher than making an additional dividend payment. As you can see, there are a number of different assumptions on the screen, and it could be quite complicated. So you have us available, you have Melanie and AVASK, and we're more than happy to go through all of the assumptions with you, and you'll also have the opportunity to view these slides following the briefing. Is that true, Melanie?
Yes. So we will be sending all this information to you guys so that you can basically just refer to. And again, if you've got any questions, we've got Stephen and Martin who will be available to help you. And again, the consultation is for free, so you don't have to worry about it.
Thank you, Melanie. So as you can see, clear benefits, even if you are a higher rate taxpayer. Now, what we need to remember is that pensions are there for retirement. And when you're looking at your pension saving strategy, it's really important to start thinking about how much income do I need at retirement? And what we've got here is an example, assuming that you would like £20,000 a year of guaranteed income for life. When should you start saving, and how much should you start saving, subject to when you would like to retire? So as an example, for a 45-year-old, you can see that if you'd like to retire at age 60 and enjoy a £20,000 a year guaranteed income, you need to be saving £46,800 a year. Turning that on its head, how could we look at it in a different way? Now, you're most likely sat there thinking, well, that £40,000, actually, I need that within the company. I'm looking to expand, I'm looking to take on more staff, I'm looking to keep it in terms of emergencies, or what else might you look to do with that capital? What I'd like to impart on you is that the longer you leave it, the worse it gets. In front of you here, you can see what a 5-year delay would look like, what a 10-year delay would look like, and what a 15-year delay would look like. So just to use that as an example, assuming you were targeting £458,000 in your pension fund to be available at age 60, you can see that delaying by 10 years means that you have a £193,000 reduction in your fund. That's a pension fund that's 42% lower by waiting 10 years. So if you're thinking, actually, I would like to wait 10 years, that's £7,298 per annum that you need to pay in more than you otherwise would have had to have done if you'd started saving earlier. So what you can see here is that there's a compounding effect in pushing the retirement conversation further down the road, stores up more problems for the future. So what we really want to encourage you to do, if anything, out of today, is to think, what am I doing about my pension planning? Because that's an important part of being a business owner. Looking that in another way, so those that are more visually stimulated, what you can see here is the impact on your retirement cake. So looking at the years to retirement and how long you wait, what is the likely reduction in your fund? So if you're sat there in your 50s thinking, I'm a bit late to the party, don't panic. There's still something you can do about it. But the part of solving a problem is identifying there's actually a problem in the first place. For example, if you're 15 years to retirement, that's a 60% reduction in your fund. We're giving you the information. The power stands with you now to take some action.
Okay, thank you very much. Thank you, Stephen. Am I on mute? Yes, I am. Thank you so much, Stephen, for the presentation. That was really, really informative. I've got loads of questions that have come in here. And what I may do, maybe, is to ask you this question, actually, because one of them that's coming says, can my company make the payment rather than through myself via the PAYE system that you, AVASK, operate on myself?
Yes, Melanie, fantastic question. That is absolutely possible. So by using the company to make the contribution, that is the most tax efficient way that a business owner director can make that pension payment. So the company absolutely can make that payment on your behalf.
Thank you. And another one is just coming, it says, how do the company claim for this particular tax relief?
Well, if it's been made by the company, it's a corporation tax relief, which means that it's an allowable business expense. So this is where we work in conjunction with Melanie. You have a conversation with her, make her aware that you're making a pension contribution, and she makes that, journals that in your account such that you can claim the corporation tax by way of your tax return. That's
correct. That's correct. So another one is coming. Why should I use a trust?
Steve?
Yes, so pension benefits are payable to your family on your passing, as I'd earlier pointed out. Now, there are different ways that you can do that. So you may find that you have multiple pension schemes that are spread across a number of previous roles and jobs, and each of those will have their own means of nominating who pension benefits go to. Now, the benefits of using a trust mean that you can choose who benefits from your pension fund, when they benefit, and how. So if you can imagine, you might have young children or vulnerable family members, and you might not want them to inherit hundreds of thousands of pounds before they may be able to responsibly manage that type of responsibility. So using trusts means that you can protect your pension fund for your family for the foreseeable future.
That is a great answer. Thank you. And another one is saying, can I set up a pension for my children and at what age?
Any age. So as soon as they're born, the government allow for a pension to be set up. And I'll cover this a little bit later in the summary. So the government are allowing you to make contributions to pensions for children of all ages.
Okay, that is absolutely fantastic. So let's move over to you, Martin, and just let's do more drill down on this financial planning, and I will continue with these questions that are coming through because there's quite a few that have come through. I haven't gone through all of them, but let's go over to you.
Thank you, Melanie. Thank you, and well done, Steve. Thanks for that presentation. So I thought it would be useful in these interesting times to make a connection between pensions and life expectancy, simply because, as you can see here, the average life expectancy for a female is 85, and the average life expectancy for a man is 83. So for those of us that are looking to plan for retirement, where typically in our 60s, mid-60s, possibly even later, people are thinking of slowing down, if you haven't made enough provision for your retirement, then you're going to be a long time poor. And what I mean by that is at the moment you stop earning money, you're going to have to rely upon your savings or your businesses to continue to pay you money. So for that reason, if you're going to retire at 60 and you may start to think about working part-time, you're going to have, as a male, some 23 years to try and make sure that you've got enough money coming into you. And that's where pension planning really works in conjunction with other assets, such that you have that flexibility of how to access those monies. And it is the case now for both men and women who are running businesses where they don't reach a retirement age and it's a cliff edge there. What they're doing is effectively blending income from a number of sources. It may well be that you've got a succession plan in place for your business where you can continue to take revenue. It may well be that you continue to be a consultant. But if you've got a large pension fund alongside it, it just means that you can access and top up your income as you need it. But the point I want to stress more than anything else is that the age group that is expanding the fastest is the 85-year plus age group. So we all want to look forward to a longer life. The point here is that we just need to have enough money set aside. Now, Steve started to talk about what happens around pensions, and there's been an absolute massive change brought about by George Osborne a few years ago, which enables us now to access pensions in a completely different way. It used to be that you had to buy an annuity effectively by law. You had no choice. You reached the nominated retirement age with your pension fund and you had to go and buy an annuity. And with low interest rates, that sort of made a lot of people very unhappy at the fact that they were having to buy effectively a guaranteed income, and they were going to have to live way beyond their life expectancy in order to see all the money come back to them. So the government is now offering this flexibility. And sometimes it's called flexible drawdown. And as an example, you can effectively have access to your pension, such that Steve has made reference to, with 25% tax-free cash, but you can moderate how you take income and when you choose to take income. So you can have a number of things. So you can take out traditional annuities still if you want to, flexible annuities, you can go flexi access drawdown. There's a vast variety of choices now. Fortunately, it's a little bit more complicated, but the point being is that it's really worthwhile, and it's something that you must consider simply because we've never been able to leave pensions to our loved ones before. Because when the annuity has come to an end, when that first death or second death has arisen, that's the end of the payment. Whereas now under flexible drawdown, families can be left large monies. And that's just quite incredible, I would say, as a legacy option. So it's something that's worth considering, if nothing else. The point and the question was raised is around children. And this is one of those things where if you wanted to be really strategic with your investments for children, in this slide here, you can see that if you started to put the contribution of 3,600 gross into a pension plan for a child as soon as they were born through to the age of 18, they would have over that timeline in excess of £1 million. And that's quite incredible. So for those of you of a similar age to myself, and I'm in my mid-50s, I would be saying to you to have that gift to enable a younger member of your family, grandchild or otherwise, to actually start saving for them in a meaningful way is quite an incredible thing. So 3,600 per annum over 18 years is quite an amazing thing. You stop them paying into it at their 18th birthday. They can't get access to it until they're 55, and I quite like that as an outcome. So they're then looking forward to quite a nice pension fund. Okay, so pensions, hopefully we've given you some sense of why you might want to re-look at pensions. Perhaps you've got a pension that you started some years ago. Maybe you've got a number of pensions that you might want to sort of dust out, bring them out to the fore again, maybe make a decision as to where these monies sit and fit within your financial plans. It tends to be that pension funds are the second largest assets to our properties and our businesses. So in that instance, it's well worth reviewing what you've got in place. Why come to us? Well, not only do we know what we're talking about, and we're backed by a large company called St. James's Place, but all of our advice recommendations and our reviews are offered free of charge. And if you take our advice, then there is a guarantee that we will stand behind that recommendation. And that's quite something in uncertain times. So if you want to be certain of having good advice, then around this particular area, please do get in touch. Thank you, Melanie.
Thank you. Thank you very much, Martin. That was, again, very, very informative. We've got we've got some questions here that have come through. I've got, hi, what if you had invested, or I've invested my pension with Boeing and Airbus this time last year, and I need, I'm in it 6 months. I think is that what Mr. Dowse is saying? I need it in 6 months. So he invested last year and he needs it in 6 months. What is it that he should be doing?
Well, I think the first thing that we would need to do is understand your circumstances insofar as how these pensions work.
Mm-hmm.
All pensions tend to have their own intricacies, such that there may well be some important benefits that we need to be alive to. So we wouldn't want somebody to be transferring a pension scheme from A to B if they were going to, say, lose a guaranteed annuity or increase tax-free cash. So when Mr. Dowse is talking about Boeing and Airbus, we'd also just need to understand whether or not that is a pension that he owns himself, a money purchase pension, or is it a final salary scheme? And if it's a final salary scheme, they come with a lot of caveats insofar as they are a guaranteed pension scheme, and you shouldn't give guarantees lightly. There needs to be a clearer investigation. But the good thing here is he's actually spotted the fact that he's got some opportunities in 6 months' time. So now is the time to do some research, because he can equally take a number of months before we gather all of the information in to be able to make a recommendation such that he's got an inquiry. So absolutely, you've got plenty of time to start planning what you want to do with these monies, but the thing to do is come and talk to us.
Okay, that is great. I would suggest that maybe you grab Martin's or Stephen's email address here so that you can reach out to them and just discuss. And again, the consultation is free. Please make sure that you get it sorted. And I've got another one here from Julia. I understand the sooner you register, the better. However, what is the ideal age to start saving up for a pension?
Excellent question. Thank you, Julia. So that's a very easy question to ask, because it's as soon as you can. So all of the stuff that we've shown you today clearly shows that the sooner the better. So the ideal age is subject to your circumstances and what your other commitments are. So if you have income over and above your needs that isn't going into something that's as efficient as a pension, why not start now? Those with cash savings will see that we're getting constant bombardment from all of the banks, all of the building societies saying, we're really sorry, we're dropping your interest rate down from not a lot to even less than a lot. So the earlier you start saving, the more value you're going to have when it comes to retirement. And as a rule of thumb, the earlier you start, the greater your pension is going to be. And it's very, very simple. Start now if you can.
The other thing I would add, Steve, to that is, of course, don't forget your personal allowances. So if you happen to be earning as an employee more than £100,000, you start to lose your personal allowance, that first £12,500 that you can receive tax-free, £1 for every two. So by paying into pensions, you're actually reducing your salary in that example and claiming back your personal allowance. So from that side of things, as a business person, you absolutely want to make sure that your money goes that bit further. And pensions, just to summarize, are the most tax efficient form of investment. And the government are giving you that tax break so as to incentivize you to save for your retirement. And they're not daft. What they're doing is they're saying, please save for your retirement so that we, the state, don't have to provide for you. And if you're running your own business, as Steve has identified earlier, taking money out of a business is subject to tax, such that your personal allowance on dividends is reduced, such that your entrepreneur's allowance has reduced. So in the sense that when you come to take money out, if you've been storing money up in your business and you want to take it out, you're going to have to face tax. Whereas if you've been taking money out of your business and putting it into pensions, you're actually reducing your tax. The key here is to build up a pension pot over time. And as Steve was saying, don't leave it. But even if you've got 5 or more years to go before retirement, you can still put in substantial money for your pension.
That's very true. That's very true. Thank you. And again, I've got Trevor. Trevor is asking, says, in the current uncertain times, how safe it is to invest in a pension. Current pension funds seems to lose a lot of value and no guarantee it will regain the value in the future. Would you still recommend investing during this time?
Very good question, Trevor. So you're absolutely right. We are in uncertain times. And what you need to be aware of before considering saving into pensions is that the value of your investments will go up and down. So when you're looking at investing, it needs to be considered over a medium to long-term time frame. So as Martin identified earlier, we're living longer and longer and longer. Therefore, you're going to have a pension fund for a lot longer than perhaps only a few years' time. So when you're looking at what's going on in the world, I typically tend to see that the press will report one thing and the real thing will be completely different. So not to be too cynical, but we need to be very, very careful not to get scared on what we're reading in the press. If you are taking a long-term view and maintaining a well-diversified portfolio, you are protected against the troughs that you might have seen in March, for example, but you're giving yourself the opportunity to build your capital over the long term. So it's really, really important to view things as a long-term strategy. Now, what I see with my clients and with investors in general is that when markets are falling, we all get really, really scared, which is absolutely natural. But let's not forget, you're going to have a professional fund manager whose job it is to take advantage of falls in value. Now, in a broad stock market sell-off, I can absolutely guarantee you certain companies will still be doing really, really well. That is an invaluable opportunity for a good active fund manager to buy a cheap or reasonably valued company for long-term growth. So in summary, focus on the long term and you can ride out short-term uncertainty.
Yeah, the only thing I was able to, if I can, is you will never time the market. You'll never be able to second guess when to go in and when to go out. Steve's made some very valid points there. Only save what you can reasonably afford. So keep yourself in cash surpluses such that you've got a business account that's got some cash surpluses in. You shouldn't commit all of that money towards pensions. But if you keep enough money back for contingent purposes and you identify a surplus, pensions can be very tax efficient. Whether or not that's coming from the company, the same principle applies if it's your own money in the bank, such that you keep enough money to one side to meet any emergency, unexpected expenditure. Only commit to what you can reasonably afford. If you're making regular contributions to pensions, you can also suspend your monthly contributions, so you can stop and start them whenever you want. And what we've also borne witness to this time round with clients that have built monies up in pensions, you can shift monies into what we call the money market fund. So if you want to ease out of equities and be more cautious, you can choose funds and profile your investments such that they're not at risk to equities to the same extent. So you choose the sort of investment outcomes that you want for yourself. But remember to make a start, have that confidence to start planning for your future, okay? You're on mute, Melanie.
Oh, am I?
You are.
Okay, can you hear me now?
Yes.
Yeah.
Okay, fantastic. So what I was going to say is that I will just echo you on that one, because it's making that start, even if it meant that you were going to be saving a little amount on a monthly basis. And again, you know, things like COVID-19, they've never happened in our lifetime, but they are happening. Nobody foresaw that something like this could actually happen. In a year's time, we will be in a better position than where we are today. So it's making that start. So Laura is just asking, says, would you say that it is better to invest in a pension instead of a cash ISA, for an example?
Well, if I could answer that one, interestingly, the government have made some changes to how interest rates, typically within a bank or a building society, are taxed. So it is now the case that if you're a high rate taxpayer, you can earn up to as much as £500 a year before you pay any tax. And as a basic rate taxpayer, it's £1,000. So in a way, taken away the need for cash ISAs to the same extent. Of course, you can go into cash ISAs, and of course, they are cash-based, so that makes them less of a risk. But in terms of an investment return, they're not going to be able to give you the size of funds that you're going to need. And we have to remind ourselves sometimes why we have risk. If all we could do was save in cash, we probably wouldn't need the stock market if we could save enough cash to live off. And it's a reason why you're all entrepreneurs and business people, is that you're backing yourself. You're the best investment. You're taking £1, buying a product, creating a product, and then selling it and making a margin. So you're backing yourself in that sense. The question is, how do you extract that profit from your business into personal savings? And if all you're going to do is sit on cash for a long period of time, that's going to count against you, because inflation, as it starts to build in our economy, is going to mean that that pound in your bank account is not growing and is not keeping pace with inflation. And equities over the longer term will tend to outperform cash all day long. Then we come to the tax structure. A cash ISA effectively gives you gross interest. In other words, there's no tax on the interest. But that's it. If you therefore went into a stocks and shares ISA, then that's much more effective. But there's no tax relief on the way into a stocks and shares ISA. So your company won't be able to take advantage of tax in the same way. But what I would say is, next to pensions, which, as I've already said, is the most tax efficient investment vehicle, stocks and shares ISAs are the next most tax efficient investment vehicle. And there's a general maxim here. If you're getting tax relief on the way in, the government will take tax on the way out. And with the stocks and shares ISA, there is no tax relief on the way in, but there are no penalties, and you can take income tax-free from an ISA. So nicely, if you could have both, such that you had a good pension strategy going forwards, and you also had a good stocks and shares ISA strategy going forwards, then you've got two really, really good complementary investment strategies.
That's absolutely fantastic. So I will be attending a women's entrepreneur event where I'm going to be talking about diversification of income streams. So maybe I'm just thinking that from this question, maybe I do need to bring this on our webinars as well here, so that we can talk about how you could diversify. And this also come at the back of what Suja just asked now. He says, how do you compare investing in BTL, which is buy-to-let properties, compared to pensions? I feel like investing in buy-to-let properties is safer for the long term, but maybe not as good as having good tax breaks. I think you've basically answered your question there. I don't know, Martin, do you wanna take that one?
Yeah, I think people have historically looked at buy-to-lets because they know bricks and mortar. We're all very, especially in the UK, obsessed with houses. We know what they're worth. We know what the next door neighbour's house is worth. I think what property demonstrates is it demonstrates how capital can grow. So capital has the ability to grow faster than net earned income. And I often use examples of the first house that you buy. And in my house in Ferndown, I paid £35,000 for it, and several years later, I sold it for £75,000. That house now is worth over £300,000 in today's market. So it demonstrates how property can grow faster than net earned income. The problem with property, as we've got its second property, is that the government has moved against us, such that you've got additional stamp duty to pay, such that you've got capital gains tax to pay on disposal. And a lot of people go, I don't declare it. Well, now, if whoever's doing the conveyancing, they will be declaring the capital gains tax for you, so don't make that mistake. So the problem with property is that whilst it's very known to us and we like it, we understand it, it's all of your assets in one area. So the chances are you'll have a main residence, and you may have one or two other properties perhaps in your property portfolio. It's all property. And the problem with that is just as what Melanie referred to there, you want some diversification going on. You want to be able to spread your assets such that you've got other opportunities to take advantage of as well. So, of course, property has a place to play, but it can't be everything that you do.
That is absolutely fantastic. Let me see if I've got another one here. He said, one is asking, what if I die and I haven't got any will in place?
That's a very good question. So pensions are separate to your estate. So pensions are their own entity. So if you have no will, you're dying in what we call intestate, and you effectively get a government prescribed will. Now, where pension funds are concerned, it's highly likely that when you set that up, you would have made a expression of wish. Or in other words, who would I like my pension funds to go to? And that will be how your pension provider would determine where that money goes on your passing.
The other thing I would add on wills and trusts, if you've got a trust around your pension, you don't have to wait for probate. As trustees, you get to jump the queue. So having a trust is a really good thing to have. It doesn't mean to say that you have to use the trust, because on death, you get that choice. But remember, 100% of your fund will be paid out tax-free if you die before the age of 75. That can be quite a lot of money. And you have the choice for it to be paid out as cash. So if you've got hundreds of thousands of pounds in the pension fund and it's paid out on first death to a spouse, that money will now sit in their estate for inheritance tax purposes. So having it paid into a trust means that it's not added to anybody else's estate. So to have that choice makes absolutely perfect sense. And we will do what we call a spouse bypass trust or an asset preservation trust. We would do a trust for you for absolutely no cost. So it's one of those great things that you should have, but most people don't.
That's great. That's also another great answer. I've got AOPA is asking, how do we know how much money we need in 30 years' time as cash loses value over time?
Well, I would use either a rule of thumb of 4% or 5%, and 5% sometimes is an easier number to do the maths on. So if you can imagine yourself at your retirement, how much income would you think you would need to live off on a monthly basis. And if we annualize that, then you're going to need to understand what that figure is. So if it was £50,000 a year net, then you'd have to have £1 million in your pension fund in order to generate that sort of income. So 5% is not a guarantee, it's only a guide, it's a rule of thumb. But don't forget you've got state pension to consider as well. And if you are paying your national insurance stamp, which I would encourage you all to do, and make sure that you've got your full 35 years, it may well be that state pensions have a lesser impact in our retirement planning, but there's still money to be had there, broadly at around about £8,000 a year. So on that basis, you've got the ability to save extra. So, you know, if you work on either a 4 or 5%, you can do the mental maths yourself.
What I'd just like to add, Martin, is what I see time and time again from clients is typically, as a rule of thumb, the further you are away from retirement, you know, that's a different person. The retired you is not you today. So it's very, very hard when looking forward in terms of what might I need? How much money would I want to spend? And what I'd like to emphasize there is that just shows you the importance of regular reviews. You need to review your situation every year.
Yeah.
How much will my pension fund be worth if I continue doing what I'm doing? And what will certainly happen is the closer you get to retirement, you'll start to crystallize your thoughts about how much money I need. And that's then an opportunity to fine-tune your planning to say, we've got enough money, or I need to do something more to get me to where I need to be. So really, really important. Over such a long period of time, you have to keep reviewing.
The other thing as well, well said, Steve. The other thing I would say is don't forget, if you're in a relationship, married or otherwise, there's invariably two pensions. So where we've been in the past is that pensions were owned by a specific person, and individually you would go and buy an annuity. Because you've got flexible drawdown, you've now got the capacity to leave your pension in its entirety to a loved one. So in the question was, how much do I need? You probably need to think of a partner as potentially having some contribution to make in relation to that overall income retirement.
Okay, that's brilliant. I have one from Trevor. Trevor wants to know that pension is a really long-term investment. If I urgently need some cash due to some unforeseen circumstances, property can, be example, be easier sold than pensions. So is there any way of accessing the pension money earlier that has been invested in a pension pot, especially if it's a large amount?
Well, yes, if you're over the age of 55 and you needed to access your pension funds, then you can. You can take up to 25% tax-free cash as an example, or you can break open the pension subject to your tax returns at that time and take additional income such that you're going to be tactical with it. You know, if you were to take all of your money out, you're going to be taxed on the majority of that money. So you don't want to be paying tax unnecessarily. But I think that's also got to be set against an effective plan that looks at such that you cannot always determine that you're going to sell a property when you want. To sell a property right now might be more difficult than, say, a few years ago. So I think it would be good to have a better understanding of your financial circumstances such that property is part of your thinking, but that you also have other assets to access should you need.
Okay, that's great. Thank you, Martin. We don't have any questions. We are right on time. So I just want to say thank you, everyone, for joining us again today. I don't know if Stephen, Martin, did you have just maybe some last words that you want people to take out of this our conversation today?
Yes, Steve.
Yeah, absolutely. So what I'd like to summarize in terms of the areas that I covered today is that these opportunities that we've highlighted are there, they're being used, they should absolutely be looked at as part of your strategy in line with how you run your businesses. And what I'd like to say is if we know anything about tax rules, they do change. So if we're not taking advantage now, who's to say that these certain benefits that you can take advantage of will be available in the future? And I would absolutely encourage you to work with us, or work with AVASK and Melanie, to work out how can you take advantage given all of the questions raised today, because what you can see is it's not a simple area of planning. There's more than one area of your own individual circumstances that you need to consider. So in summary, I'd like to say you do need to take advice.
Yeah. I totally agree about the rules changing year on year. The benefits, they come and go. It's like the entrepreneurs relief was brought down from 10 million to 1 million, which is a lifetime one. Whoever thought of that? So which means that is a huge loss for entrepreneurs that they've lost on the entrepreneurs relief, for people that haven't sold out or come out of business on time. So which means they're going to be worked on tax. For the people that come out before the new introduction of the new rules, they are obviously on the happier side, I could say. So Martin, on your side, I mean, what would be the last words that you'd like people to take away from this?
I would just encourage people to go and have a rummage around and see if they've got some old pensions somewhere that they've just forgotten about, because that's money there that's you've saved, that's probably not being focused upon. And I always say to clients, it's really important that your money works as hard as you do. So if we think of endowments all those years ago when people took out endowments and people forgot about them, pensions, for some reason, it's the same thing. We're all a little bit sort of scrambled in our thinking when we start talking about pensions. The reality is they're incredibly useful tax vehicles. They can do a hell of a lot of good for you, your family. And the legislation around pensions is relaxed to such an extent that you've got a lot more freedom. And there's where the questions have been coming around property, which I think is absolutely fine. We all love property, no problem with it at all. But pensions can now sit alongside some of those investment strategies so that you can get tax relief. And as Melanie said, a diversified approach is absolutely the way to go. Now, your businesses, you are really successful at what you're doing. You're trying to be imaginative and creative in finding new clients and establishing profit for yourself. Sit down with Melanie and her team. Make sure that you're keeping a little bit extra back in your bank account so that you can make ad hoc payments to pensions as and when you can afford it. But make those additional payments along the way on your journey to success. Just give yourself a little bit of an opportunity to put some monies into pensions for you. If your plan is to sell your business, and it would have been that I was going to take the £10 million worth of entrepreneur relief, then you're not going to be able to do that now without paying tax. But if you would take £40,000 out of your pension every year, and out of your company, and put that into a pension every year, you'll be building yourself up your own little nest egg that you don't tax onto anybody else, and you still get the other £1 million. And if you've got your partner in the business, there's nothing to stop you making a contribution to his or her pension as well as your own. So pensions are deservedly worth another look. And I understand if it's something that you probably haven't considered for a long time, please take a moment, take positive action. Pensions have a valuable outcome for you if you just give it a little bit extra.
Yeah, I would say that before I wind up, there is actually a question, a very, very interesting question. I can't avoid it. Martin, they are asking here as to what if some people want to move abroad? What could potentially happen to the pension funds? Would they be paid overseas?
Yeah, so pensions, the first thing I would say to anybody that's going to move abroad is get financial advice before you go. Okay, that's the first thing. Because the moment you become resident overseas, the ability for somebody in the UK to give you advice on a UK-based pension ceases the moment you leave the UK shores. So we're regulated by the Financial Conduct Authority, and therefore we can give advice to anybody that's a UK resident. The moment you leave us, it's that moment that stops. Of course, when you are then resident abroad, you're then going to need to get financial advice from somebody that in wherever that country that you're based. And as long as you're communicating with HMRC and also Melanie, then obviously you will negotiate with HMRC as to how tax is going to be deducted at source, should that pension be made payable in the form of an income or otherwise. If you therefore want to move that pension and transfer it into an overseas pension, then you can do that. And then, of course, you'll be liable to the taxation of the country that you're now living in. So get advice. Don't just assume. Go and make sure that you find somebody to go and speak to, such that you can understand what the rules are as they now apply to you. Because each country looks upon their citizens and taxes them differently.
Okay, that's absolutely amazing. Thank you again for all this great session that we've had. It's been absolutely wonderful to have you guys on board with us this morning. And also, I just want to say, for everybody that is here, please do reach out to the team at Lester Brunt, who will be more than happy to support you. And again, if you wanted to have a chat with us, or you want us to be part of the call that you're going to be making to Lester Brunt, definitely I'll be there to hold your hand and assist you all the way through. And thanks again. We are back again next week, Thursday, with our expanders. I have some great American friends in business that we'll be hosting next week. So join us again at the same time next week, Thursday at 6 p.m. We appreciate you all and have a fantastic weekend. Thank you, Martin. Thank you, Stephen, and all the best. We will have you guys again soon on another topic.
Thank you. Bye-bye now.
All the best. Bye-bye now.
Everybody. Bye-bye. Keep safe.
Bye.